Major funding for these programs is provided by grants from HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, Allied Partners, Bank of America, Murray Hill Properties, SJP Properties, Greenberg Traurig LLP. Additional funding is provided by grants from Antares Investment Partners, Arbor Realty Trust, Athena Group, BRT Realty Trust, Burden LLP, C.B. Richard Ellis, City Habitats, City Investment Fund, CUSHMAN and Wakefield, Eastern Consolidated, Essex Capital Partners, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, Jackson Development Group, Meridian Capital Group, McSam Hotel Group, Newmark Knight Frank, Moynihan Organization, Muss Development, PALIN Enterprises, Rosenthal and Rosenthal, Signature Bank, Sidney Fettner Associates, Stonehenge Partners, Studley, SUTPHIN Properties, the WITKOFF Organization, Extreme Construction and Deconstruction.
Hello, my name is Michael Stoller, host of the Stoller Report, Real Estate Trends in the Tri-State Region. The office market is a very interesting market, but in reality, 7 years ago, in my 7th season, I did a television show where I assembled 3 dynamic individuals to talk about the office market. And today we were supposed to have the same 3, but due to the illness of Steve Siegel's mother in Florida, we weren't able to do it. And that was a show airing at 11 o'clock at night on radio from Shallot's Kosher Restaurant. And sitting over there and having dinner was Jim Kuhn, the president of Newmark Knight Frank, Bruce Mosler, the president and CEO of CUSHMAN and Wakefield, and sitting in Mitch Rudin's seat was Steven Siegel. But so we have Mitch Rudin today taking the Steve Siegel place over here. Mitch is the president of the New York Metro region of C.B. Richard Ellis. But, you know, 6 years later, the world has changed. I mean, it's been, you know, as someone said, I hate to use the biblical approach, we've had, like the Bible and Joseph, we've had 14 great years. And now it's a little difficult. So what's happening, Jimmy?
Well, I think that the 3 of us would probably be hoping that we would have this show done in about 3 months, because I think that we're at the tip of an iceberg, and I'm not sure we know where the iceberg's going. But let me say this. The economy has been based on asset inflation for the last 3 or 4 years. The structured investment vehicles, the financial conduits have no reserves behind them. And so as a result, you have financial institutions that are being forced to bring in sovereign wealth funds and other investors to beef up their balance sheets. And it's going to dilute their balance sheets, and now they're going to have to do something about it. And I think, unfortunately, we're going to have layoffs. And I don't think we know how deep the layoffs are going to be, but I think that we're at a very beginning of what I see as a very, very tough year. And whether it's a recession or not, I think that 2008, coupled with the, I think, standstill in fiscal policy because of the election, I think we're going to have some difficult times for the next year.
But what happens with these layoffs, you know, in the renting space in the New York market or the tri-state region, or as you see this, if the layoff is there, if Citibank, XYZ, investment bankers, they lay off, you know, these people had this insatiable appetite to lease space. They were taking more and more space. The law firms were taking more space. They needed all the space. What's going to have that effect on the office market today?
Well, fortunately, we've had the benefit of those people taking more space, incremental or otherwise. So if you wanted to take a static shot of what the market looked like today, we're in very good shape. We're at historically high rents in most places. We're at historically the availability rates are at historical levels that any one of the 3 of us would sign up for the rest of our careers. And while you never want to see anyone laid off, and we do anticipate that layoffs will happen, given the size of the market and the health of the market, they have to be fairly significant before they have an impact here. I mean, if you just, rough rule of thumb, 5,000 jobs, puts 1 million square feet on the market, which is 0.3% to the vacancy rate. So you've got a ways to go. And that assumed it comes on at the same time. That assumes it's contiguous. And what you're seeing others, as we were talking before, people have been fairly prudent about running their businesses. And one of the differences, when you contrast earlier times, since over the last 6-7 years, the businesses that we've worked with have been very prudent in how they've run. They've been conservative in the space that they've taken. They've been rethought how that space is laid out. They're conservative in how they run their businesses, as we are with all of our companies, even as we went through this glorious time period, so that you don't have those wild swings. And when you're now in an environment where we all need to be more cautious, you don't have to retreat quite as much.
I'd just piggyback off of what Mitch just said. We really are, at this moment, experiencing very strong fundamentals. And Jimmy's absolutely right. This is a clear period of uncertainty. But we have had the benefit of an extraordinary 3 or 4 years. And when you look at the state of the market today, one thing we can't speak to is supply. We know the supply, rather. We know supply right now is at all-time lows. We're below equilibrium, way below equilibrium, and as Mitch said, rents are at an all-time high. We don't know what demand is going to look like in the future. We do anticipate some layoffs. It's unclear if the layoffs will translate into a strong or even a vibrant sublease market.
If you're a major landlord, not a major landlord, if you're running a company and you're looking for your bottom line and you're saying, I need space, do I really want to do this major expansion? Do I want to go to one of these buildings where somebody may have paid a very high price for that building, that they need a certain rent? Or will I say, I'd rather stay at 100 Park Avenue. I've been here for many years. Or, Bruce, I know you're at 51 West 52nd Street.
Why are you looking at me asking me that question?
No, maybe you need space. Or, Mitch, you've outgrown 200 Park Avenue. You need additional space. But I don't know. I don't have my crystal ball, my amazing Kreskin over here. I don't know what it's going to be. Do I really want to expand? Do I want to take that lease? Don't you see a corporate executive saying that to themselves?
Well, I don't think. I think what Bruce was saying before is, fortunately, the vacancy is so low and the supply is so constrained that it's almost inconceivable to have a major correction. Having said that, I think that you're going to have CEOs of companies be very careful about taking expansion space. And so as a result, tenants that have already outgrown their space and don't want to pay triple-digit rents will probably look for alternative neighborhoods. The great thing about New York, and in a bad market, this is the city you want to be in, is you can go anywhere in the city today and be in a neighborhood that's vibrant. So if you don't want to pay $100 a foot, you go pay $70 a foot, you go pay $50 a foot. I think that you will see some give in the middle part of the market. I think the top of the market is extremely strong, and that's the market that, depending on the results of the financial community, may stay strong. And even if it gets a little weak, so instead of $150, maybe it's $120, maybe it's $100. Depends on where you're playing in the cycle.
To make the point further on what Jimmy just elaborated on, if you're a tenant in the marketplace today looking for anywhere from 50 to 100,000 square feet or up, you have very few choices. Today that marketplace is very tight. And if you have an alternative, that alternative is likely to be 1 or 2 Class A type of buildings. So I think if today you're looking for space and you have an alternative that's in the $80, $90, $100 range, you have to take it.
Can I ask you, and I think you were the agents who did this, Ogilvy and Mather had their space at Worldwide Plaza, and they were on 8th Avenue, which has changed to be a good neighborhood today for office space, and they decided to move to 11th Avenue, this is a major company. This is not a little company. They're moving to 11th Avenue. And why are they moving to 11th Avenue?
Look at who is the workforce today for the creative end of the business. I will tell you, my son has no desire to live in Midtown. And what these corporate executives have now figured out is that if they move to an alternative neighborhood that's hip, they're not going to lose their employees like 20 years ago. So the choices for companies to move in the city have been expanded because of creative destruction, because of the fact that new industries are popping up, new companies.
But
and
Jim,
workforce.
it's not only new companies. Lord & Taylor has space on 38th Street. They have all their office staff over there. This is not a creative industry. This is not a hip industry. It's a garment industry. They're moving to the Starrett-Lehigh building on 12th Avenue. It's economics.
It's one of the great things about this city, and why it makes it unique within the United States, is the diversity of industry. Just as we've sat here, you've pointed out a variety of industries, and we haven't even touched on the fire sector. Look, over the next 5 years, 63 million square feet of leases are turning. Those people are going to have to make a decision, whether it's to move or stay. They have to make a decision. And a point that Jimmy made before, by way of example, when he was talking about pricing, because of how we sit now as a global city, and because of the strength of the marketplace and the absence of large amounts of new construction, there has been a fundamental shift in pricing. So that $150 space, should the market turn, should the pessimists be correct, and I'm not one of them, and it goes down, it's not going back to $60 what it was, or $70. Jimmy's right. It may retreat to $130
no different than
or
the price
$120
price
or
of oil is
something
not
like
going
that.
down to $40 a barrel in our lifetime.
This has changed, and all you have to be is representing someone who's engaged in a simultaneous search in New York, and whether it be London or Paris or Hong Kong or
all of you have so
But Mitch makes a really important point. We look at $150 rents and we say, my gosh, that's pretty high, and we've traveled a long way to get there. When you look at us on a global comparative basis, we're maybe the 8th highest rents in the world. We have a long way to go, and there is potential upside when, as you mentioned, Mitch, this sort of pessimism wears off.
Well, let's omit this Manhattan-centric discussion.
Okay.
We have people from around the world who watch this. There are other boroughs. There is the Gold Coast. There's Brooklyn. Now, Brooklyn had planned 7 million square feet of new construction. Now they're talking about only 1.4 million square foot. And I had on my show a couple of weeks ago someone who has a couple of buildings in Brooklyn, and he says, I'm having difficulties renting space. Now, you go to Brooklyn, good transportation,
But
downtown Brooklyn?
Michael, this is the self-fulfilling prophecy that keeps our market strong. And that is that we've had an inflationary cycle in almost everything. The cost of steel, cost of concrete, the cost of construction in general. And as a result, you can't make these deals pencil out in these boroughs. And so with no new construction to undercut Manhattan, it keeps the market somewhat constrained. I want to raise one red flag, though, because we all know that the financial sector is the underpinnings of the New York market, especially in the highest end in the Plaza District. And I still feel that with not only the home housing market that has gone belly up, but you're next going to have the credit card market, the student loan market, the auto market, and the CDOs will start to unwind. And there will be many hedge funds that will go out of business. And so I think that there will be somewhat of a ceiling on where rents go over the next year. I personally feel there'll be no rent growth, which is not such a terrible thing where we are today. But I think that there is a red flag out there in the financial sector that we have to see how it's going to impact the economy. And to the extent that the U.S. economy slows down, it will impact the world economy, because the United States and its declining dollar is a really serious problem for the whole world.
Just on the rent side, we had an extraordinary year, but call it roughly, Midtown rents went up approximately 25% this year. And looked at it, while it was much stronger in the first half, for the last 5 months of the year, close to 1.5 points a month per year. And we all knew about this. There have been no surprises continuing into December.
and deals continue to be done. I mean, I think Jimmy's absolutely right. You have to look at what is happening in the financial marketplace, and it is 40% of the total market of New York, and say, we have to be cautious. On the other hand, over $100 billion has been written down by the financial institutions at this point. I think through the first quarter, we'll see a lot of this, I think, be driven out. And at some point, that market and that particular industry is going to correct itself.
Now, do you see companies, because, you know, I remember I did a show a couple of months ago, and Jerry Gottesman was on the show, and he said, I had a tenant who I was going to move to Newark, and they decided that they wanted to go to Hoboken to save money. Do you see companies who are in Manhattan, and we were talking before about the law firms, who have said, you know, I don't need all these people over here. I know some of the accounting firms, you know, have, you know, they call hoteling, where most of the people are out of the office. Do you see them going to Westchester, the Gold Coast of Jersey City and Hoboken, Brooklyn, Long Island City, where they had planned?
You can't lump them all together, Michael.
Fine. So
if you go to New Jersey, the benefits you get there, especially the payroll tax, for an investment bank, you can build the building for free. I don't think you can compare Jersey to necessarily Westchester, Connecticut. If you're an insurance company, you may go to Connecticut. But I don't think you're going to see massive construction in these markets to accommodate that. So yes, you'll have a little bit of slippage into the Jersey City market potentially, but nothing of the magnitude that impacts 400 million feet of space in New York.
Well, I would come back to a point that Mitch made earlier, because I think it was very important. Businesses have been running very efficient operations for the last 3 to 5 years. And no one has been warehousing space. No one has been out there taking more space than they need. And I think that there are two reasons and 2 points I'd like to make. First, business today, I think, looks at being as efficient as they can, but also understands the value of being in a midtown or a downtown Manhattan. There's a value proposition there in terms of the talent that you recruit, in terms of the interplay between people and the productivity that you get. People want to be here. That's the reason we've seen rents rise as rapidly as we have. Secondly, whether it's the Gold Coast or whether it's any other suburb that is in close proximity to New York, they've benefited by the fact that rents have risen so sharply. So there is a propensity to look at your operation and say, can I put part of it outside? Can I put part of it inside? But in the end, I think businesses have made the decision, as much space as we can take in Manhattan itself and be as efficient as we possibly can, that's kind of where we'd like to be. And that's one of the reasons we've seen not just the renaissance of New York, but the explosion in terms of the
Can I bring up something? Yes, Mitch.
Almost a year ago to the day, the mayor and Senator Schumer issued a report that they had commissioned by McKinsey, comparing New York to London and talking about the threat to New York if we don't adjust our regulatory, our immigration, and our litigation practices. And as part of that study, they surveyed financial services executives, and they came up with 18 criteria under which a financial service executive makes his or her decision. Commercial real estate cost was number 12. Yeah. Obviously, the first few, number 1 was the quality of individuals that you get. The next 6 or 7 were all related, the type individuals and the things that continue to attract people. Number 12 was the cost of real estate.
You know, Bruce brings up the fact that, you know, when you go to the Europe and everywhere else, our rents are reasonable and the rest. But there are companies, and I've harped on this in my articles and my classes and other things, that there are companies, there are true nonprofit companies who cannot afford to stay, and you represent a lot of them, Jimmy, and you've sold companies, and all 3 of you have been involved with this, but you take that nonprofit who really has a mission to handle, and their mission is not to pay $100 a square foot rent, and they're being priced out of certain parts of the city. So what do we do about that? Or even, you know, and I always say this, there's an accounting firm I know at 226 West 26th Street. You know, it's a small accounting firm, these small little businesses who had these $22 rents and all the others, or even the rents even at 100 Park Avenue, 125 Park Avenue, and they can't afford this magnitude to go up. What happens? We have to adjust. We don't want to lose these companies. They're part of the...
Unless you're talking about rent regulation, there's not a lot of what you can do. I think a lot of these nonprofits are going to just have to take less space, and their employee count for square footage is going to just go down, and they're going to have to survive because they don't want to really move out of the city because their development base, their contributors, don't want to have to travel out of the city, and many of them made decisions, very tough decisions, to bite the bullet. Getting back though to what I said before, and the thing that concerns me, Michael, is that, you know, we tend to sit here and we raise the flag for New York, but we sometimes get myopic when it comes to the world economic climate, and that still concerns me, because with the price of oil and the potential where you could have stagflation, like back in the 70s, where you have inflation in various parts of the economy, but you have slow growth in the economy, that monetary policy of lowering interest rates is not going to help if you don't have any asset inflation. And so, you know, you could end up in a situation over the next couple of years where you have a serious economic problem, and it will impact New York less than most cities.
I mean, let me give you the biggest problem that I see in New York. It's not the office space. It's the fact of our housing for our workforce. Our workforce, they're spending more than 50% of their, you know, dollar on housing. So we don't have enough housing for this workforce people. Then, if you just look, and I was at a restaurant, we were talking about, this week I was listening on 1010 Wins just before my show, and I heard that a gallon of milk is $4.24. And then I was at a restaurant, and the guy said, "Do you really? You know, we buy a lot of eggs. Eggs have been up 42%. I mean, all of these other things. I mean, we you know, without, you know, this market, you know, there's a lot of things going there. You know, people. It's a difficult world we're in today.
That's why the mayor is made a mandate for affordable housing in the city. Unfortunately, with the volume cap that's pretty much non-existent at the time, you know, the 80/20s are in limbo, and the 421A has eliminated in some of the boroughs the ability to do, you know, 80/20s.
But I'm getting to the fact that every one of you all run these large businesses. You have workforce people. Yeah. They have to be housed somewhere. Long Island, we did a show 2 weeks ago, and we were saying you know, people can't even find housing.
The problem is not with our employees, Michael. Our employees will put 3 in an apartment if they have to.
That's right.
The problem is the middle class, as it's defined today, a family of 4. Where do they live? That's the bigger problem, not our employees. Our employees will figure out where to live if they want to be in Manhattan. But the real problem is
I'm talking the 5 boroughs. I'm not even talking.
Yeah, but Michael, you bring up a very good point. I mean, if our businesses are going to continue to thrive, we're going to have to pay attention to housing, which I think is the macro point you want to make. And I think none of us have the immediate answer, but we touched on this actually in your last show. We have to have some plan to deal with this. So whether it is subsidized housing or whether we find some other form of incentives to get developers on the ground that can provide affordable housing for the city, there has to be a thoughtful plan. Whether that's part of Hudson Yards or one of the boroughs or all of the boroughs, that's something
I know Jimmy's involved with Hudson Yards, so I can't really discuss Hudson Yards. But, you know, let's talk about the Trade Center. I mean, there is going to be space being built in the Trade Center. There's going to be space in Hudson Yards. Sure. I mean, there are only right now 4 or 5 new developments being planned, which I think can all be absorbed because they're not really major developments.
And they're out there.
And they're out there already. Right. They're on the horizon. Everything is either they broke ground or they have their plans over there. What do you see happening in the office market? I remember we spoke 6 years ago. Nobody wanted to go to Lower Manhattan when we sat together at the show. 40% vacancy.
Well, it was more challenging.
It was much more challenging. And today, what's happening in Lower Manhattan in the office market?
Oh, you're looking at, for the first time in 7 years, where the availability rate is lower downtown than in Midtown. You take a 7 World Trade Center where they've leased 1.2 or 1.6 of the 1.6 million square feet. And it is a highly desirable location when you consider the alternatives for users. And whether you go back to the charities, where are they moving? A lot of them are moving to downtown.
Absolutely.
They're moving to second, Class B and Class C buildings, which are all being upgraded. Very nice homes for them. And on the residential side, look, we understand we all need to do more, but the private sector has reacted and has accomplished. All you have to do, go to Hoboken. I mean, what has happened in Hoboken is extraordinary, and it has become home for a lot of young people who can't afford Manhattan, nor can they afford Brooklyn Heights.
I mean,
look at Williamsburg. Look at the various neighborhoods in Queens.
I did a show in Newark, and Arthur Stern, who's been the first person who's ever renovated a new apartment complex in Newark in 42 years, basically taking an office building. He said most of the people who live in my building on Broad Street basically come from New York City because it's a great alternative.
But let's go back to your question about what happened to downtown. Post 9/11, first of all, we lost almost 12 million feet, maybe more. Secondly, we saw a conversion of commercial space that was obsolete to residential. And that conversion now, I think, is in excess of almost 5 million feet. And lastly, we see a vibrancy now downtown that's driven rents up now exponentially. You're talking about at Seven World, mid-70s, and the next round will be higher than that for brand new product. So downtown is really right now almost the place to be.
If there's going to be downtown product, why do they still have to give incentives? I hate to use the Ophi or Denny situation. What do you need to provide these these tenants who are going to downtown incentives?
It's not
the short answer or the long answer?
The short answer.
Well, as time goes on and it becomes more of a 24-hour environment, you'll need less incentives.
That's right.
We've needed the incentives because we didn't have that.
Today,
but don't forget,
what Mitch said, look at the vacancy.
But Michael, we dodged the bullet.
That's right.
We were one tenant away from having that debacle again, and that was because Merrill Lynch was going to move to Midtown. That would have been the worst thing for the city, and I think that the fact that they renewed for 5 years will once again allow downtown to continue to grow as a community. It's still a double commute for people coming into the city, so it's never going to be everybody's first choice.
I don't know if I would say it would have been the worst thing for the city, because it certainly would have picked up another neighborhood in Penn Plaza. But on the other hand, I think that
Penn Plaza has a lot of office space.
It's fantastic, and it is a thriving neighborhood. But at the end of the day, I'm not sure, had that firm moved there, if that was going to be the case, I'm not sure it would have been or signaled, a reversal for downtown. It certainly would have been a hurdle, but at the end of the day, I think downtown is beyond losing one major tenant. It really is a thriving area, and the reason we need to continue to incent people to move down there, Michael, is because it isn't, as Jimmy said, 24/7 yet. It's moving aggressively in that direction, but you still have to help support downtown. It's downtown.
To put three of you together, 30 minutes is never enough. And I know that before the end of the season, we're continuing, we're going through the end of August. We will all be back together. I'd like to thank Jimmy Kuhn, Bruce Mosler, and Mitch Rudin for being here. See you next week.
Thanks for having us.
Thank you.
Major funding for these programs is provided by grants from HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, Allied Partners, Bank of America, Murray Hill Properties, SJP Properties, Greenberg Traurig LLP. Additional funding is provided by grants from Antares Investment Partners, Arbor Realty Trust, Athena Group, BRT Realty Trust, Burden LLP, C.B. Richard Ellis, City Habitats, City Investment Fund, CUSHMAN and Wakefield, Eastern Consolidated, Essex Capital Partners, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, Jackson Development Group, Meridian Capital Group, McSam Hotel Group, Newmark Knight Frank, Moynihan Organization, Muss Development, PALIN Enterprises, Rosenthal and Rosenthal, Signature Bank, Sidney Fettner Associates, Stonehenge Partners, Studley, SUTPHIN Properties, the WITKOFF Organization, Extreme Construction and Deconstruction.